From time to time, Dave and I tend to talk about, well, all the time, we talk about accounting incentives. So Dave's probably mentioned the concept of the big bath to you before. So before I start today, I saw an article on the Economist Espresso app yesterday. This has been around for a few weeks now. Tesco is one of the main retailers in the UK. And let's just say it's been having a pretty bad year. I think it's made its biggest loss ever. So we usually talk about the big bath, where you write down stuff if you've got a bad year. Usually if you're a new manager, so you blame the previous guy and so you look better. But even if you're not a new manager and you've got a bad year, you do what politicians do, which is take out the trash. If there's some really bad news, hide some other bad news on the same day so people don't notice it. Well, this is what Tesco's doing. In the UK, they refer to it as taking out the kitchen sink, but it's essentially the same thing. Tesco's got a really crap year, so what they're doing is they're writing down as many other assets as they can. And we know what the impact of that's going to be, right? You write down depreciating assets. Next year, your depreciation's less. So even if you don't actually do any real stuff, the accounting looks better next year. Okay, so that's just something that came up in the news. Just quickly introduce myself. I'm Robert Trankowski. Dave's already put a post. He probably told you I'm coming. Dave's down in Melbourne. I think he's at the AASB today. We do try to keep in touch with standard setters. So every now and again we fly down to Melbourne or go to London or what have you. I've been teaching this sort of stuff for a shitload of time. I was at UNSW for 17 years. Then I went to Sydney for 3 years, which was the biggest mistake of my life, except for my third psycho girlfriend, who was a bigger mistake, but yeah, shit happens. And they all happen at the same time. And this is my 7th year at UTS. I've been teaching on ASR and the postgrad equivalent for most of that time. So even though you haven't seen me. If you need to contact me, that's my email address, or just post on the ASR Facebook page or UTS Online, and I will see it. Or if there's anything for me, Dave will let me know. Okay, so today we're talking about leases. Today we're going to talk about leases. Now, if you've heard the word lease, you probably have a rough idea of what it is. A lease is just a contract where one person pays the other person money and that other person lets them use an asset. It's really a rental arrangement. So if it was as simple as that, I'd basically just say debit, lease, rental expense, credit, cash, and we could all go home. So why are we spending an hour and a half here? We're spending an hour and a half here because of something that used to happen before we had the current leasing standard. So I'll get back into the slides in a few moments, but I just want to talk, we don't have anything to scribble with. I just want to look at how companies might approach raising finance. Because if you rent something, there's no impact on your balance sheet, right? I mean, debit, lease, credit, cash, okay, a little impact. Your assets don't change a lot, your liabilities don't change a lot. So potentially, I could fly down to Tassie and rent a car for 3 days and give it back at the end of 3 days. I'm paying a very small proportion of the value of the car. I'm not really being responsible for any maintenance on the car. So that is clearly a rental arrangement. However, at the other extreme, I think Dave's put in a picture of a Qantas plane somewhere along here. Blah, blah, blah. Oh, I thought he had. Oh, he usually does. Doesn't matter. At the other extreme, I could basically say, look, I want this asset. I want it for a long period of time. How about I go up to a finance company and I say to the finance company, you buy this asset for me, and the asset's going to last 10 years, and I'll lease it off you for 10 years. Now, why would I do that? I mean, why would I lease something for 10 years since, think about how the leasing company is going to price that. It wants most of its money back. So it's going to price that lease by saying, look, I want back the money that I invested in the lease, in the asset, and I want a reasonable rate of return. Well, your money back plus reasonable rate of return, another way of saying principal plus interest. If you're leasing an asset for most of its life, the person leasing it to you is going to treat that almost like a loan. Okay, so they're going to price it like that. But why would you even do that? Why would you care? Let's have a look at what I'm just going to scribble on the first page. Let's have a look at your two options at getting an asset. One option is the traditional approach. So you've got a balance sheet with assets on one side, liabilities and owner's equity. Okay? So the traditional approach, if you want an asset to use and you don't have the cash, is borrow the money and buy the asset. Okay, so if you borrow the money and buy the asset, your assets go up and your liabilities, sorry, it's a bit hard to draw with a mouse, and your liabilities go up. I wonder if I can draw with my finger. Oh yeah, awesome. Don't know why I was doing that. Sorry, new technology. So your assets go up and your liabilities go up. So what are the implications of that? If your assets and your liabilities go up, it's pretty obvious that your debt to asset ratio, that's meant to be a D, your debt to asset ratio is going to go up, or debt to equity if that's the way you measure it. So by doing that, a balance sheet measure of risk is going to change. Now that might not matter to you. If your debt to asset ratio is low, you don't really care. Hey, that's cool, it goes up by a bit, that's fine. But if you're close, if you've already borrowed money and the contracts you've got say something like your debt to asset ratio can't go above 30%, and you're already sitting at 28%, borrowing money to have your debts and your assets go up might stress you. Because even if it doesn't get you to 30%, if you have a bad year and your profit really sucks, your assets might go down. And suddenly you find that you are violating a debt covenant. And when that happens, what happens? Your lenders come in and say, oh, let's renegotiate the debt. And when lenders come in and say, let's renegotiate the debt, you go, no, please, let me keep the money. They say, yeah, okay, but pay us more interest. So renegotiating debt involves the possibility of facing a higher cost of capital. So these rules in contracts matter. If you break them, it costs you real money. So if your debt to asset ratio is already high, you might not want to do that because this risks you violating a debt contract. Now, I'm just looking at a balance sheet there, but remember there are also other measures of risk. If somebody lends you money, they're not just going to say, hey, your debt to asset ratio has to be below 30%. They're also going to look at income statement measures of risk. So on the income statement, the times interest earned ratio, earnings before interest and tax, divided by interest is a measure of risk. That's sort of a safety margin for lenders. So the times interest earned ratio, if it's big, lenders feel safe. Now, if you borrow money, you're not changing a normal expense, like lease rental. So you're not changing an expense that goes additively into earnings. If you borrow money, you are changing interest expense. And interest is the denominator of this ratio. So if you double your interest, you halve your ratio. Okay. Don't worry if you're not 100% comfortable with that. All you need to know is that if you borrow money to buy an asset, you look slightly more risky. For many companies, that might not matter. For some companies that are already pretty risky, it might matter. So if you didn't have the standard we're going to talk about today, what's your alternative? Well, the Leases standard, the original Leases standard came in when I was at second year uni. In fact, where you are right now. I won't say what year it was because, shit, I feel old. And the reason it came in was that companies that were in this situation said, all right, look, I could borrow money and buy an asset, or I could go up to a finance company and I could say, hey, how about you buy an asset and I'll lease it off you? And in that case, if you look at their balance sheet, there's no change in assets, there's no change in liability, so unless you're late with a payment. So there's no change in the risk measures on your balance sheet. On the income statement, yes, EBIT divided by interest changes, but by a lot less because the change is an additional expense in earnings. So it's an additive change. It's not something on the denominator, which would be a multiplicative change. So the change is a lot less. So look, companies had this option. They could say, I'll borrow money and buy an asset, or I'll lease it. For many companies, it probably didn't matter. For those that already were carrying a lot of debt, it probably did. So here's the problem that we face today. There were companies out there that leased assets for a short period of time. That's cool. They're legitimate leases. There were other companies out there that said to a finance company, look, buy this asset for me and I'll lease it off you for all of its life. Now, if I'm leasing an asset for all of its life, that's not really a normal rental, is it? I mean, it's not, because the finance company doesn't give a stuff whether you're renting a car or a plane. They're not a car rental company or a plane rental company. They're a finance company. In fact, they probably don't want the asset back at the end. They're happy to lease it to you for its entire life. So what they're going to do, how are they going to work out your lease payments? They don't want the plane back at the end, so they're going to say, all right, I've paid $50 million for a plane. So what I want back out of this lease is I want back my $50 million plus a reasonable rate of return, plus interest. So when they work out the lease payments, they're going to work that out exactly the same way as they would work out a loan. Principal plus interest. So the numbers are going to be calculated the same way as a loan. Okay, so this leads us to the main issue today. Some leases are genuine leases. They're rental arrangements. Some leases, even though they're legally called leases, are actually loans. Okay, the legal term is a lease, but the economic reality is that you are actually financing the purchase of an asset. And the way the lessor prices the lease is exactly the same way as a lessor, as a bank would price a loan. So, if they're economically the same, why should the name of the document matter? We generally say in accounting that what matters is measuring the economic substance of the transaction, not the legal form. So even though the legal form is a lease, a rental arrangement, the economic substance is it's a financing arrangement. So really we're trying to achieve two things today. Firstly, how do we tell the difference between a lease that's really a rental and a lease that's really a financing arrangement? So we'll spend the first part of today talking about that. The second thing, the obvious one, if it is a financing arrangement, how do we account for it? And hopefully most of what you'll see there is straightforward, although some of the terms are a little bit funny. So I'll spend some time explaining those. And lastly, we'll look at another type, a specific type of that situation, a sale and leaseback, where you lease an asset, but it's an asset you originally owned to start off with. So you sell the asset and then you lease it back. So it seems like an asset sale, but it's not really. You're actually using the asset for financing. So basically that's where we're going today. So sorry I didn't give you slides to look at, and operating leases are going to be easy, right? We're going to tell the difference. We're going to try to tell the difference between a finance lease, which is a financing arrangement, which involves recording an asset and a liability, because that's the economic reality, and an operating lease, which is just a rental. So when you see the operating lease slides, it's going to say debit, expense, credit, cash. So that's the easy one. The finance lease is the complex one. So, sorry, David likes animations. I prefer my slides to come up all at once. So what is a lease? Legally, a lease is, it's a rental arrangement. So there's one person, the lessor, who's got an asset, and they allow the lessee to use it in exchange for payments. All right, we've got a motor vehicle. And there are different reasons you do that. Look, generally, it tends to be the lessee needs finance to buy the asset, or the lessee just wants to rent something for a short time. Sometimes leases are done for strategic purposes. Many years ago, Toyota created a new brand. I won't tell you what it is yet, but you probably know. And as far as everybody was concerned, this new brand was just another piece of plastic shit from, sorry, let me rephrase that. Who cares? It's just another piece of plastic shit from Toyota, right? So Toyota's trying to say, look, this car's awesome, you should buy it. But everybody said, hey, why the hell should we? Well, Toyota knew people would say that. Bear in mind, in the US, if you buy a car, maybe this has changed the last few years. Last time I was in the US and I actually watched some TV, you see US car ads, half the ad is about the car, half the ad is about finance. So it seems like, unlike here where you tend to take cash or get a loan from a bank, people go in and get financing from the dealer. So a lot of people lease their cars when they buy them and they pay them off. Okay, so Toyota basically said to people, if you want to buy one of these cars, what we'll do is we'll organise a lease for you with a finance company, but leases usually have a big final payment, the residual. Toyota said, we will guarantee that residual for you. So if after 3 or 5 years you want to walk away from the lease, that's okay. We'll pay the lease off for you. You can walk away. Now, Toyota did that strategically, right? Because if people did walk away from the lease, Toyota paid off the lease and they took the car away and put it in a warehouse somewhere. Think about the strategy there. That meant that after the leases were coming up, there weren't many of these cars on the second-hand market. People felt safe walking away because Toyota would pay off the rest of the lease, and people wouldn't see any second-hand versions of this car because Toyota stored them away in a warehouse. So you thought, there aren't many second-hand ones, so people must really love them. So therefore, it must be a really good car. And yes, it's a con job, but people fell for it. People came around to thinking that this was a luxury, high-end car. And so after a few years, Toyota didn't have to do that anymore because the reputation was built in people's minds. So now, the plastic piece of shit from Toyota that's called the Lexus, people actually think is as good as a Beamer or a Merc. People actually think Lexus is a good car. Let that sink in. It's a Toyota product. Okay? So sometimes this stuff's done strategically. Anyway, so a rental arrangement, but depending on how it's structured, it can be a financing arrangement. Okay, so we've already talked about the two ends of the spectrum. The two ends of the spectrum for leases are that you can rent something, you can lease something for the short term. If you're leasing it for the short term, it is clearly a rental arrangement. Alternatively, if you're leasing it for the long term, it can be a financing arrangement. And okay, so I've given you the two ends of the spectrum. Somewhere in the middle, there's a dividing line. So we've got to focus on where that dividing line is. And that dividing line is likely to change in the next few years. So if they're financing arrangements, we're going to have to account for them as finance leases. If they're really rentals, well, we're just going to account for them as we would normally account for rentals. Oh yes, an SMS from Dave. I asked him if he's at the AASB. He said yes, he's at a workshop on the conceptual framework. Now those definitions of assets and liabilities, they're talking about changing them to new, more stupid ones. So hopefully if Dave gives them some input, hopefully they'll pay attention to him. Okay, so are these things economically significant? Dave's put some numbers up there from Qantas. Qantas is a little bit strange. It's different than some other airlines. There are many airlines out there that lease almost all of their assets, almost all of their planes. With Qantas, it's a bit more of a mix. So Qantas actually owns a reasonable amount of its planes, but it still leases quite a few. So there's a lot of stuff there that's leased. Now, I don't know if Dave's put up the quantum of operating leases. Yeah, he has, because this is significant. They're talking about changing this standard. The methods that we're going to learn today aren't going to change, but where they apply changes. So why are we talking about recording financing leases as finance arrangements? Because if it's a finance lease, it's like you've got a liability. If you're intending to make all the payments for the life of the lease, for the life of the asset, then it's really a financing arrangement. Now, from the criteria we see today, we will see that some things qualify as finance leases, some things are just ordinary operating leases. However, some operating leases cannot be cancelled, or they can only be cancelled with difficulty. They might still qualify as operating leases. The standard setters at the moment have rewritten that standard, except it's a bit of a mess, so I'm not sure when it's going to come in exactly. It's a hideous new standard. The methods are the same, but instead of talking about finance leases and operating leases, they're going to talk about Type A and Type B leases. In the new standard, all of the stuff we're going to look at in the first part of today how do you recognise a finance lease is going to be irrelevant. What they're going to say in the new standard is, can you cancel the lease or not? If you can't, then it's a liability, right? Even though it might not be a financing arrangement. So the structure of the new standard might be different. So be aware that that's likely to happen in the next year or two. Anyway, companies have to disclose the amount of their leases, obviously. If you've got operating leases, then the only thing that gets reported is lease rental expense. But if you look at the notes to the financial statements of any company that's got operating leases, it has to disclose the cash flows it expects those operating leases to cause. So if I'm renting something and it's not a financing arrangement, it's an operating lease, it's a normal rental, I have to say, how much cash am I going to pay within the next year, within 1 to 2 years, 3 to 5 years, and 5 years plus? So that information has got to be somewhere in the notes. Now that's actually pretty useful, because if you're a person who looks at these financial statements and you think that this standard sucks, and you think that operating leases should really be recorded the same as finance leases, if you've got the timing of cash flows, then you could do a rough present value calculation, right? A rough present value calculation. And you could say, all right, these operating leases, they're not recorded as liabilities, but if we recorded them, how much would we record? So you can sort of answer the question, if operating leases were capitalised, would our debt to asset ratio go up? Okay, useful information. So this is a situation where some people might say the standard sucks, but there's enough information in the notes for you to make a rough adjustment if you believe that operating leases should be capitalised. All right, so AASB 117. The key characteristic, the key thing that enables us to distinguish between a finance lease and an operating lease, remember, we want all financing arrangements to be treated the same. So when is it a financing arrangement? It's a financing arrangement if you've got most of the risks and benefits of ownership, right? So if you look like an owner, if you're facing the responsibility for maintaining the asset, if the asset suddenly dies, you're the one who suffers. If the asset increases in value, you're the one who benefits. So if you get most of the risks and benefits of ownership, then it's a financing arrangement. Even though under a lease you don't legally own it. Okay, so that's how we pick up a finance lease. And we'll see a bit more guidance for that in a minute. If it's not a finance lease, then it's an operating lease, right? Which is sort of a lazy way of defining it. But think about what we're doing here. If this standard didn't exist, a lot of stuff would be classified as operating leases, even if they're financing arrangements. So this standard is trying to say, well, hang on, we've got to look at those finance leases and grab any that are really financing arrangements. So we're trying to define things into financing leases. Anything that isn't a finance lease, it's okay to record it as an operating lease. Okay. Yeah, I noticed Dave puts paragraph numbers up there. I don't get hugely stressed about that. You can look it up. I deleted paragraph numbers from my slides because they keep changing. And I'm too slack to change my slides every year. Oh, sorry, did I just say that? Okay, so to pick a financing arrangement, we're asking the question, does it look like you're an owner? Okay, now remember the definition of assets back from week 1, hopefully. The definition of assets says, for it to be an asset, there's a past transaction, there's present control that enables you to extract future benefits. Notice the present word is control, it's not ownership. In almost every other circumstance, control and ownership are the same thing. So, you just say, oh yeah, control, ownership, same shit, who cares? But when you get to this standard, it makes a difference. And control is the key thing, because ownership is a legal concept. Do you legally have title to this thing? Whereas from an accounting perspective, we're looking at the economic substance. So even though you may have dressed it up as a lease contract, if it's really a financing arrangement, you're really buying the asset. Okay? So control is the thing that matters, not ownership. Okay, so how do you work out whether it's a financing arrangement? there are some key terms here that I'll come back to. Firstly, transfer of ownership at the end of the lease. Oh, one thing I need to say, the way this standard works, you need to consider all of these things together. You need to consider all of this evidence. Now, some of this evidence is stronger, some of it is weaker. When the original equivalent of this standard came in 31 years ago, so now you know when I was in second year, seemed so long ago. When the standard originally came in, instead of having this, you had a flow chart. And the flow chart said, is the lease cancelable? If the answer is yes, it's an operating lease. If the answer is no, you looked at some of this other stuff. So at the bottom of this flow chart, you had finance lease and operating lease. It was pretty easy to work out what was what. There is a danger with having precise standards. And I'll talk about that in a few moments. So we don't have a flow chart. We've got to look at all of these things together. But look at the first one, transfer of ownership at the end of the lease. That is a pretty strong indicator that it's a financing arrangement, right? If I pay off the lease and I get to keep the asset, it looks like a financing arrangement, right? When I took out a mortgage for my house, when I paid off the mortgage, I got to keep the house. Wow. So if you get to keep the asset at the end, it's probably a financing arrangement. The payments go away, but the asset is still there. So that's really strong evidence. It's not 100% conclusive, but it's pretty close. Okay, secondly, the lessee has the option to buy the asset at less than fair value. Why does that matter? You've got a lease that goes for a bunch of years. At the end of the lease, you think the asset's going to be worth 10 grand. But the lessee gets to buy the asset for 3 grand. Now, why would that happen? In a fair market, that wouldn't necessarily happen. Unless what is really happening there is the lessor is acknowledging that the lessee sort of has part ownership of the asset. It's like, but the lessee has part ownership of the asset. It's like the lessee has paid off some debt. So we don't care about the fair value, we care about the amount of debt that's outstanding. So if the final payment on the debt is a lot less than the value of the asset, then you're probably not buying the asset because you've already got it. You're probably just paying off debt. So the fact that the final payment is a lot less than the fair value is a way of acknowledging that the lessee has sort of paid off some of the debt and so sort of has ownership rights. So that's a reasonable indicator that this is a financing arrangement. This can actually be structured in slightly more complicated ways. Right, at the end of the lease, you can pay off. Look, generally the way leases tend to be structured, they're going to have equal payments, monthly or yearly, and at the end they're going to have a bigger payment. So we're talking about that last payment. I've leased my car as part of a salary package deal for UTS. So I leased my car for 6 years. Hang on, no, I extended it for 7 years. And at the end of the lease, I think I get to buy my car for about 9 grand. I think at the end of the lease, it'll be worth about 16, right? That's probably suggesting that my lease is really a financing arrangement. Well, I'm hoping it's worth 16. I haven't trashed it too much, so it's okay. Okay, alternatively, the contract might say that at the end of the first lease, you get to renew the lease, but the renewal is at a less than market rate. So 5 years from now, to rent this asset, it costs you $300 a month, but you get to keep renting it for $100 a month. In other words, your payments are lower if you extend the lease. Well, that's sort of acknowledgement that you've got part ownership. If you feel uncomfortable with that, think about how a loan works, right? At the beginning, you're making big interest payments. Towards the end, you're making smaller interest payments. So the ability to renew at a lower rate is also sort of acknowledging part ownership. Okay, the lease term is for a major part of the asset life. Now, I want to come back to major part, so just underline that for a bit. But this is the story I told you at the outset, right? We basically say to somebody, look, I want to lease this asset for most of its life. And why is that significant? If the lease is for the major part, then that means you are going to extract most of the benefits of that asset's life. And the lessor ain't going to get much back at the end because you're using up most of the asset. So the period of the lease covers the period when you're extracting the benefits, and you're going to be extracting most of the benefits of that asset. Okay, we'll come back to that one. Lastly, the present value of the minimum lease payments amounts to substantially all of the fair value of the leased assets. I'll come back to what minimum lease payments are in a few moments, but think about how somebody prices a lease. Dave doesn't do that, so I'll need to do it. Okay, think about how you price a lease. If I go to Tassie, rent a car for 3 days, those lease payments have almost nothing to do with the value of the car. Right? It's simply a question of what the market can bear. If I give it back early, hey, they don't care. They can always find somebody else to lease it out to. However, if I'm going to lease the asset for most of its useful life, the lessor wants their money back and they want a reasonable rate of return. Right? So the payments, I mean, what's present value? Present value is just payments with the interest taken out. Right? When you divide by 1 plus I squared, 1 plus I cubed, you're taking the interest out. So the present value of the future payments, if that's close to the fair value of the asset, that means that the amount you're paying off on this lease, loan, lease thing, is close to the value of the asset. So it's like you're paying off an original borrowed amount. So if it looks like you're paying off an amount that's roughly equal to the value of the asset, then it's probably a financing arrangement. Right? Whereas if I rent a $30,000 or $50,000 car for $100 a day for 3 days, that present value of that is certainly nowhere near the value of the car. Lastly, the leased assets are specialised. So let me give you an example of that. One of my students from years ago from UNSW ended up working for a dredging company. There aren't many dredging companies. Okay, what's a dredging company do? You know, when ships come into harbours, especially with Australia mining, got all these little harbours around Australia, they silt up due to erosion, due to crap building up at the bottom of the harbour. So what a dredging company does is it brings in huge machines and it cleans the crap out of the bottom of the harbour, right, to stop the harbour getting shallow so the ships can keep coming in. Now, when I was mentoring her through a CPA, she was working at the dredging company, and there were only 2 dredging companies in Australia at the time. So imagine that this dredging company goes out and leases some equipment. Right, this is very specialised equipment. If you lease a dredging machine, there's only one other company in Australia that could use this. So what's the finance company going to do? It's going to make sure you damn well can't get out of that lease. Because if you get out of it and give back the asset, firstly, what's a finance company going to do with a dredging machine? Kill some bankers? Oh yeah, that's an idea. Sorry. They're not going to be able to do much. They can't redeploy it easily because there's only one other competitor in Australia and they probably have all the machines they need. To redeploy a huge dredging machine somewhere else, closest significant ports, Singapore, maybe the other side of the Pacific, maybe East Africa. To move that dredging machine that far is going to take a bit of money. So the costs of redeployment are substantial. So if the asset is specialised, it's really hard to just go, you know, oh yeah, go on eBay. Anybody want to rent a dredging machine? Yeah, right. It's really hard to redeploy it. So that basically means if the asset is specialised, you want to make sure that this guy isn't going to walk away from the lease. So an asset that is specialised for the circumstances of the lessee suggests that it's likely to be a financing arrangement because the lessor is going to cover his butt to make sure that the lessee can't walk away from this arrangement. Okay, now I've underlined 2 terms up there, and I just want to talk about those briefly. Oh, look at this technology. Yeah. Major part. I'm going to write 75% there, and substantially all, I'm going to write 90%. That's meant. Oh, it's really hard to draw with your finger on this thing. That's meant to be. That is a 0. Yeah, whatever. Now, those numbers aren't anywhere in the standard. When I was an undergrad, those numbers were in the standard. So major part meant 75%. Substantially all meant 90%. Those numbers are not in the standard now, not officially. But when people think about major part or substantially all, those are the numbers they think about. They are in the US standard. And this actually brings out one of the differences between American standards and international standards. International standards were largely driven by English-speaking countries and France, Japan, one or two other places outside the US. Outside the US, we take what's referred to as a principles-based approach. So we have broad approaches. We don't get stuck on all the details. Whereas when you look at American standards, they're very detailed. Now, having a detailed accounting standard can be bad. And this is a good example of that. Let's say that you're an American company, you enter into a finance lease, but you don't want it to qualify as a finance lease. Then you will make sure that the lease is for 74% of the asset's life, and that's easy to do because useful life is a subjective estimate, and you'll make sure that the present value of the payments is 89% of the fair value of the asset. And depending on the asset, you could probably fudge fair value as well. It's not a level 1 fair value, you can probably use some subjectivity there. So you can rig this classification by going in for 74% and 89%. And in the US, that would enable you to say it's not a finance lease, it's an operating lease. But under the international standards, if you had 74 and 89 and you went up to your auditor and you said, hey, dude, this is an operating lease, he'd say, yeah, bullshit, come on, who are you trying to kid? It's clearly a finance lease. You're just outside, you know. And the point is, the rules aren't clear. So because they're fuzzy, it's really hard to get around them. If you actually want it not to be major part, then making it 74% isn't enough. You probably need to push it down to 50. To stop it being substantially all, 89 probably isn't enough. You've probably got to push that a lot lower. But you know what? If the lease term is 50% of the asset's life, and the present value of the payments is 70% of the fair value, then it probably is an operating lease anyway. Right? So by having fuzzy rules, we're actually making it harder to get around those rules. Right? One of the advantages of principles-based accounting standards. Whereas when the rules are detailed, people get around them. And if you've looked at Australian tax law, what happens when you've got detailed rules that people get around? The politicians come up with more detailed rules. So when I graduated, the Australian Tax Act was that thick. If you guys do tax law, it's about that thick now, right? Because they keep plugging holes. Well, if we have a principles-based approach, we don't need to worry about people avoiding that. Okay, now let me give you the definition of minimum lease payments. Look, one of the criteria here is to say, what are the commitments? What are the payment commitments that you're making? Now, I think to illustrate this, I usually whip up a spreadsheet. So let me give you an example of a really simple lease. I'm just going to make these numbers up. Let's say you've got one lease. Let's make that a bit bigger. Let's say you've got one lease that's got a bunch of payments and then it's got a final residual payment. I'll need to say a little bit about residuals in a moment. So let's say we've got 3 leases that are basically the same. They've all got payments of 100 a period, and at the end of the lease, there's a 700 residual payment. One comment about that final payment. We're calling it a residual. Whoops. Sorry, it's too bright here. I can't see the keyboard. Be careful about the use of the word residual. When you've seen the word residual in account, residual in English just means the leftover bit, right? So when we've used that word so far in accounting, residual has been the scrap value of an asset. Residual in the case of a lease means the final payment. Now that can get confusing because what are you usually leasing? You're leasing an asset. So the asset's got a residual for depreciation calculation purposes, and the lease has got a residual. They don't have to be the same. They're separate concepts. They might be the same by coincidence, but don't assume they're the same. The residual on the lease is not the same, or not necessarily the same, as the residual value of the asset. Okay, so that's what the residual is. So a lease is basically, you've got a bunch of payments periodically, and then usually a bigger payment at the end. Not always, but often they're structured like that. So let's look at 3 different situations. Let's assume firstly that the residual is guaranteed. And then next we're going to say unguaranteed. And next we're going to say unguaranteed but a bargain purchase option. Okay, so firstly, let's focus on what guaranteed means. Because we're trying to work out what the minimum lease payments here are. What is your commitment? So I'm going to highlight those in a minute. If your residual is guaranteed, what that basically means is you are guaranteeing that the lessor is going to get that much value at the end. Now that can be structured differently. One lease might just say, hey, at the end you've got to pay us $700. Well, that's pretty obvious. Duh. Another lease might say, at the end of the lease you've got a choice. You can pay us $700 or you can give us back the asset and we will value the asset or sell it. And yeah, like we trust them to value it. Maybe we get somebody else to value it. And if it's worth less than $700, you've got to make up the difference in cash. So a guaranteed residual basically means that at the end of the lease, you're up for $700. You've got to hand over $700 worth of value. Okay, so if you've got no choice, the $700 must be part of your minimum lease payments. Okay, so that's why I've made the whole thing yellow. All of those things are the minimum lease payments, and they're the things that you calculate present value of when you want to come up with present value of minimum lease payments. Okay, the second one, an unguaranteed residual. What's an unguaranteed residual mean? Well, it's not guaranteed, so you don't have to pay it. So an unguaranteed residual means at the end of the lease, you can choose to pay the $700, and if you pay it, you get to keep the asset. But if you don't pay the $700, you can walk away. The lessor takes back the asset, and if it's worth $200, well, that's his problem. So an unguaranteed residual means you don't actually have that commitment to the $700. So the minimum lease payments would not include the $700. Okay, now let's look at a bargain purchase option. A bargain purchase option is a particular type of unguaranteed residual. If I've got an unguaranteed residual, I don't have to pay it. But imagine that at the beginning of the lease, you negotiate this lease, there's an unguaranteed residual of $700 at the end, but you actually think the asset's going to be worth $2,000 at the end, right? If you think that after 5 years or 6 years or whatever it is, the asset's going to be worth $2,000, but you get to pay $700 to keep it, then you'd be an idiot not to pay it. So even though it's theoretically an option, theoretically you don't have to pay it, legally, economically and commercially, you've effectively got to pay it. Even if you don't want the asset, you'll pay the $700 and you'll sell it to somebody else for $2,000. Right? So you'd be an idiot not to pay it. So the thing about a bargain purchase option is that it is an unguaranteed residual, so legally there's no obligation, but economically it's pretty obvious you're going to make that payment. Right? So what I've done now is I've highlighted, on the screen it's yellow, up there it's a sort of greeny thing. Wacky. Oh, whatever. I've highlighted what the minimum lease payments are. They're your commitments. They're the things you can't avoid. So the present value of those payments must be your liability. So what have we basically said, coming back to the slide? Coming back to the slide, we include in minimum lease payments the required periodic payments, so the $100 a year or a month we were making. We include the guaranteed residual value. So if it's not guaranteed, we don't include it, unless it's not guaranteed and it's a bargain, in which case we do. Okay? So that's basically what that slide says. Now, look, since I've got that up there, I think Dave's probably got this further on, but let me just give you the symmetry of that for the lessor. So this is for the lessee. Let me just put that there. Okay, now what about for the lessor's perspective? For the lessor's perspective, what we're going to call all those numbers is the gross investment in the lease. And for the lessor, it doesn't matter which one it is. The lessor always includes the residual. Think about why that might be the case, and think about why they're different. If you're the lessor, how do you price the lease? You price the lease so that the final payment roughly reflects the value of the asset at the end. But remember, these guys have got different information. That's why it's potentially possible to have, with the unguaranteed residual, the lessee thinking, look, I'm not up for it, I'm not going to pay it, but the lessor thinking you will. And especially if you're somebody who uses this asset regularly, and the lessor is a finance company who might have less of a clue, it's possible for there to be information asymmetry. So the lessor always includes the residual. So in 2 out of 3 of those circumstances, the lessor's accounting and the lessee's accounting will be mirror images of each other. But if it's an unguaranteed residual that's not a bargain purchase option, the lessee's liability will not be the same as the lessor's receivable. Okay, because we've got different information. Okay, so the lessee works out the minimum lease payments and uses that to work out whether it's finance lease. So by discounting that, in other words, taking out the interest, you get the present value of minimum lease payments. The lessor discounts his thing, and the discounted gross investment is called the net investment in the lease. Right, so that's the terminology and how it fits together. So basically, in most circumstances, what the lessor will do is the mirror image of what the lessee does. Oh, there's a car. Maybe Dave's dreaming about having an Audi. I don't know. I'm too old for that stuff. Okay, so let's look at the accounting for it. Now, the key thing that you want to get from this slide is this bit. The lessee, right, what we're talking about here is the journal entry for recognising the finance lease. So debit leased asset, credit leased liability. What's the amount of that journal entry? The amount of that journal entry is the fair value of the leased property, or if lower, the present value of the minimum lease payments. So if they're the same, no-brainer. If the present value is higher, use the fair value. If the fair value is higher, use the present value. So what are you using? Using the minimum of the two, right? So minimum of fair value and present value of minimum lease. Oh, it's really hard to write with a finger. Better writing with a mouse. Present value of minimum lease payments. Okay? So the minimum fair value and present value of minimum lease payments. Now, what if there are some costs associated with organising the lease? Well, the cost of an asset is the cost of getting it ready for use. So if there are costs associated with the paperwork, they get added to the cost of the asset over and above that. The last line there should be obvious, right? You cannot set off leased assets and leased liabilities, right? You can't cancel one out against the other. Because if you look at what I did at the beginning, I said, look, the whole point is, on the left-hand side there, if it's a financing arrangement, we want assets and liabilities to go up. We want the debt-asset ratio to look higher because there's more risk. If you get to cancel the liabilities against the asset, instead of adding them to the liabilities, assets will go up, assets will go down again. There'll be no difference, right? So I think it's pretty obvious that you're not allowed to set off for an obvious reason. Because if you're allowed to set off, then you defeat the purpose of the standard, which is to show that you're really facing more risk. Subsequent measurement. Look, I hate this paragraph because it seems a bit blah. It basically says minimum lease payment shall be apportioned to produce a constant periodic rate of return, blah, blah, blah. What does that really mean? It means you're just going to do the same table that you've always done for debt before. So when you did a debenture table, the opening balance is a present value, then you've got a column where you add the interest, a column where you take off the payment, and you get a closing balance. And that becomes the opening balance for next year. And you're always calculating the interest using the same rate. So, no-brainer. We are treating this the same as any other debt. So if you remember how we do the debenture tables, same stuff here. No diff. A subsequent measurement of the asset. Mainly a no-brainer, except for this last point. So even though it's part of a lease, you still do all the thinking about the asset like you think about normal assets. So what did it cost us? Well, we've just worked out what the initial journal entry is. Estimate its useful life, estimate its residual value. That gives you a depreciable amount, and it tells you how to depreciate. So depreciation, call it amortization if you want. Depreciation is fine. Calculating the depreciation isn't a problem, with one exception. The useful life is usually the physical useful life of the asset, the period over which you can economically use it. However, what if you are planning to give the asset back at the end of its useful life? So you're planning to, it's not a bargain purchase option. It's not a guaranteed residual where you're paying cash, but it's a guaranteed residual where you're handing back the asset and maybe some cash. Or it's an unguaranteed residual where you're handing back the asset. If there's no certainty that you're going to keep the asset, it's likely that you add it back, then what period are you going to get the benefits out of that asset? It's not going to be its physical life, it's going to be the lease term. So if there's no certainty that you get to keep it at the end of the lease, then you don't depreciate over physical life, you depreciate over the lease term. So that's the one thing to watch out for. If you're not going to keep it, then those benefits have to be spread over the 5 years of the lease, not the 8 years of a useful life, for example. Yep? Yeah, if it's a guaranteed residual, it's part of the liability. So it's part of the, it's a minimum lease payment. So the guaranteed residual is a payment you have to make, and so therefore it is included in the present value calculation. Okay. So that's how we deal with the asset. And obviously leased assets can be impaired and all the other stuff. Operating lease, I hope that's a no-brainer. Right? Remember, an operating lease is just a normal rental. So debit, expense, credit, cash. Lessors. Initial recognition. The lessor recognises, right, so what's the lessor doing? If it's a finance lease, the physical asset goes away, credit asset, and instead a lease receivable arises in its place, debit lease receivable. So, and that's the net investment in the lease, which is the present value of the gross investment in the lease, which is basically, if you remember what I did in Excel there, just the present value of all the components, including the residual. So I've given you that definition, I've given you that definition. That's cool. Now, notice the last bit on this slide. Any unguaranteed residual value accruing to the lessor. So that's basically saying the lessor always includes the residual. Doesn't matter whether it's guaranteed or not. Because think about it, how does the lessor set the residual? The lessor sets the residual thinking, oh, that's probably what the asset will be worth at the end. Why would it be different for the lessee? Because the lessee has different information, different experience. So the lessor might say, oh yeah, that's what the asset's worth at the end. The lessee will say, oh, that guy's an idiot. I've got a different conclusion. Okay. Subsequent measurement, this constant periodic rate palaver again. Well, that's just saying you're going to use that table again, just like the benches. Operating leases, no-brainer. With an operating lease, you keep the asset, so you're still depreciating it, doing whatever you do, like budget rent-a-car does. And income is recognised on a straight line basis over the lease term. Now, that's actually a significant issue. If all the payments are equal, that's a no-brainer. But what if the payments aren't equal? What if there's a big payment in the first year and smaller payments in all later years? This last line says you have to recognise the income on a straight line basis. So if your first payment is bigger and your others are smaller, some of what you've got in that first payment, that first receipt, is not revenue. It's a prepayment of stuff later. The revenue in an operating lease will be even. If the payments aren't even, then there will be either a prepayment or a payment or a delayed payment. We never really give you examples with that, but it's important for the real world to remember that straight line recognition of income is what's done for an operating lease. So debit, cash, credit, operating lease income. Okay, we'll talk about sale and leaseback after we have a look at the in-class one. Where is it? Oh, yes, there it is. I thought I didn't bring it. Actually, when these classes were 2 hours, I'd give people a break in the middle. If you feel like stretching your legs or arms, stand up for 2 minutes. Yeah, we'll take a 2-minute break. Okay, so let's have a look at the worked example. This is a pretty straightforward example. Good choice of name. Plummet Airways leases an aircraft for 5 years on 1st of July 2007 from ABC Bank. Fair value of the aircraft at the start of the lease is 100 mil. Lease payments are 16.1 mil, annually in arrears with a guaranteed residual of 50 mil. The rate implicit in the lease is 7.5%, and the useful life of the aircraft is 20 years with a zero residual. Okay, so the depreciation's a no-brainer. 100 mil airplane, depreciate 5 million a year. Two things I want to say about the question before we go into it. Firstly, if we ever give you a question with a really precise payment like that, 16,108,236, it's probably a good sign that we've rigged the question to make sure the present value of the payments equals the fair value. But you can't trust us on that, so you're going to have to check it anyway. So if you calculate the present value of the cash flows, those payments, and including the final payment at 7.5, you do in fact get present value of minimum lease payments equal to 100 mil, which is equal to the fair value. And to be honest, that's reasonable, because with a guaranteed residual, that's what the lessor would have done in setting the payments. The second thing that sort of sucks about this problem that you've got to look out for, and there's a reason we do this, notice the payments are annually in arrears. So the first payment is at the end of the first year. Now, I don't know how many of you are renting accommodation, but wouldn't it be awesome if you could move into your accommodation and make the first payment at the end of the 4 weeks? Run away 3.5 weeks and rent a new place. Yeah, well. So, look, realistically, this is not how leases work. Realistically, in a lease, you're going to make a payment up front. So why have we set it up like this? Because from Dave and my experience, if we do it more realistically, most people use the normal present value tables. And the normal present value in the annuity table assumes the first payment is a year away, the next one is 2 years away, next one's 3 years away. But we don't always do that, right? About 20% of the time, we'll set an exam question that's actually realistic. So the first payment is straight away, the next one's after 1 year, the next one's after 2 years. So if you remember that, if you read the question carefully, if the payments are annually in arrears, use the normal present value in the annuity table. If payments are annually in advance, then the first payment doesn't need to be discounted. So if you've got 5 payments, discount the 4 using an annuity table and add on the first one. Or alternatively, discount an annuity in arrears for 5 years and then bring all the payments forward 1 year by multiplying by 1 plus R. Up to you. The point is, read the question carefully. 80% of the questions in the textbook and in our exams tend to be like this, unrealistic, where the first payment's after a year. 20% of the time, we make it more realistic and we make the first payment straight away. So it's important to read the question carefully. Okay, so as I said, given how we do the accounting for this, we just set up the normal table. So ignore this column because that's just an information column. What are we doing each year? And the order's a bit weird. Normally we say opening plus interest. Well, interest is 7.5%. That's the implicit rate times the opening balance. So you can see that's right in the first one. It's right in the later ones. So we take the opening, add the interest, take off the payment, gives you the closing, right? Not hugely intellectually challenging, I hope. Okay, so what's the journal entry you would do at inception of the lease? Well, fair value is 100 mil, present value of minimum lease payments is 100 mil, so 100 mil, leased asset, leased liability. Payment at the end of the first year, well, just read it off the first line. Don't forget to amortize or depreciate the asset. We're not hugely stressed whether you call it amortization or depreciation. Remember, 100 mil asset, 20 years, zero residual. So that's the 5 mil. The final payment on the lease, the 50 mil, what is the entry for derecognition of the lease liability on 20th of June? Yes, that's sort of right. And I'm sort of okay with it. But to be honest, what are the payments you make at the end of the 5th year? You make 2 payments. You make the final lease payment of 16.1, and then you pay the residual of 50. You're not going to write 2 checks on the same day to the same guy. So realistically, the final payment you make is actually 50 plus 16.1. So if you were to say 50 mil for that entry, that's cool. If you were to say 66.1, that's also fine. Okay, because both the last 16.1 and the 50 happened to the same person on the same day. So maybe we should change the demo. From the lessor's perspective, same numbers for the calculations. At the inception, what happens? Remember, this is a finance company. So they bought the asset. They're not making a profit on selling it. So they're probably getting rid of it at the same amount it's recorded at. So get rid of the asset, bring back the lease receivable. And then you account for the lease receivable as the guy who's given a loan. So you use the same table, same numbers, but the other way around. Notice that lease revenue, that should probably better be described as interest revenue. And the lease expense up here should probably better be described as interest revenue, interest expense. Look, to be honest, you don't actually have to call it interest, but it qualifies as a borrowing cost. And so it has to be disclosed as your borrowing costs. Whether you call it lease expense or interest expense is secondary to where it gets classified. Okay, so that's the demo. Are we cool with that? Marginally? Okay. Sorry, this whole finishing in an hour and a half is, on the one hand, it's awesome, because I get to have some breakfast. On the other hand, it means we've got to do things reasonably quickly. Okay, sale and leaseback. So let me just make sure I'm in the right place. Dave's only got a few slides for this, so I might actually, I might drag out some other slides if I've got some somewhere else to show you how some of this works. What's a sale and leaseback? A sale and leaseback is a financing arrangement where you originally own the asset. In fact, so let's have a look at how that would look. I'll just whip something up in Excel. Okay, you've got an asset. Let's say you've got that asset sitting in your books at 90 bucks. And let's say that asset's got a 10-year useful life left, right? So we're expecting its depreciation to be that. Now, what you do in a sale and leaseback is you sell the asset. Sorry, sell. Let's put sell in quotes. Okay, let's assume there's no accumulated depreciation to keep it simple. So get rid of the asset, 90 bucks. There's going to be a gain on sale, or maybe a loss on sale, and debit cash. Now, the asset's recorded at 90, but hey, its fair value might be 150. So you walk up to a finance company and you say, hey, do you want to do a sale and lease? Hey, baby, you want to do a sale and lease back? Yeah, okay, that's cool. I'll give you 100 bucks for it. So this guy gives us 100 bucks. So we've got a gain on sale. Again, I'm going to put that in quotes because that's wrong. We're going to put a gain on sale of 10 bucks in. In fact, I'll make that red. And then, immediately afterwards, we lease that asset back. So debit leased asset and credit lease liability. 100 bucks, 100 bucks. Let's make it a bit bigger. Format it, make it pretty. Ooh, look at that. Isn't that pretty? Sorry, having pretty slides is a waste of time. Okay, what have we really done? Remember that whether you've got an asset is an economic issue, not a legal issue. It's about control, not about ownership. What we have really done there is borrowed money. I'm really hoping that's because you didn't get enough sleep, because I know I'm boring, but I didn't think it was that bad. God, I feel so inadequate. side issue, talk about inadequate. My girlfriend's got a friend, a male friend, whose name in Chinese translates as satisfactory. Join the dots, guys. When he gets married, and just someone yelling out, satisfactory. Sorry. Okay. So, how is that even remotely relevant? Oh, because she didn't get enough sleep, that's right. Okay. So, what is this? This is really borrowing money. You own the asset, you sold it to these finance guys, and then as soon as you sold it to them, they gave it back to you as a leased asset. So you had control, you've got control. The only thing that's changed is title. It's now legally owned by the lessor. So what you've really done here is you've borrowed $100. And that lease liability is basically representing you owing that money back. So if the asset hasn't really been sold, right, the asset's just been used as security for a loan. So that gain on sale isn't real. That gain on sale is really a side effect of the fact that you've used the asset for financing, which is why I put gain on sale in quotes. Now, why would you do this? Why would you use a lease to borrow money instead of going out to borrow money? Security, right? If I'm going to lend you money, I can lend you money unsecured and trust that you'll pay me back. I could lend you money with some sort of charge like a mortgage, but if you don't pay me back, I've got to jump through a bunch of legal hoops to get the asset that I've got a mortgage over. Or I can lend you money through a sale and leaseback. Now, what is awesome about a sale and leaseback? If you sell it to me and I lease it back to you, I legally own the asset. It is legally much easier to seize an asset that you already own. So the costs of collecting are a lot less. The risk is a lot less. So that's why it's good for the lessor. And if it's good for the lessor, it's also good for the lessee. Because if the borrower knows that the lender is going to face low risk, the lender will require a lower return. Right? Risk and return are correlated. So you might enter into a sale and leaseback simply because it causes you a lower cost of capital. Right? It's a cheap way of borrowing. Or if it might not be the most convenient because they can come in and seize the asset, as an airline called Ansett found out, which is why you've never heard of Ansett. But basically that's what it is. Okay, so why would you do it? Now think about the implications. The problem with doing these journal entries is if you've leased that asset, you're now going to depreciate that asset based on what you've recorded at, which is now $100. So your depreciation is going to be $10 a year. So your depreciation is going to be bigger than it would have been, even though the economics of the asset haven't really changed. So over 10 years, that's $10 more depreciation. Why? Because you've reset the asset from 90 up to 100. What represents that reset? The gain on sale. So that's why we're not going to call it a gain on sale. Instead, we're going to call that deferred gain on sale. Okay, now what are we going to do with that deferred gain on sale? Over the life of the lease, I'm lazy, so I'm just going to copy that. Over the life of the lease, we're going to move some of that each year out of the gain on sale, out of the deferred gain on sale, and put it into gain on sale of asset. What does this mean? What is now the net effect of holding the asset? Each year, so let me write each year there. Each year, you're going to have this gain on sale of the asset of 1, and you're going to have the depreciation of 10. So what is the net effect of holding the asset? $10 depreciation, $1 deferred gain on sale gives you a net effect of 9, which is what the depreciation would have been anyway, right? Now, it doesn't always work because the lease term might not be the same as the asset's useful life, but it'll sort of roughly work. So what you've got to do is if it's not a real sale, i.e. it's a sale and leaseback, The gain can't go to profit. The gain's got to be deferred. It sits on the balance sheet and it dribbles out to profit over the life of the lease. So that's how you deal with a gain on sale. Okay? So, Woolies, last year, announced, I don't know if they've gone through it, sale and leaseback of a hotel property portfolio. Example, there used to be a good clip on YouTube from The Daily Show, but I think it's been, in Australia we can't access that. The Arizona Parliament in the US, a lot of American states are really financially stuffed at the moment. So Arizona did a sale and leaseback on its state house, in other words, on its parliament building, because they were so desperate. And it turns out they didn't even know how they'd make the second year's lease payment. So I don't know how that's worked out. But when you're desperate, sale and leaseback makes sense. Okay, so if it's a finance lease, what are we doing? We're doing what I exactly showed you. We're saying, look, the gain isn't real, so we shouldn't put it to profit. Instead, we keep it on the balance sheet and we slowly dribble it out to the income statement so it offsets that extra depreciation. What about if it's an operating lease? Look, the rules for an operating lease are a bit complex because there are three things to consider. There's the carrying amount of the asset, there's the value you're selling it for, and there's the fair value. And if you look through the relevant paragraph, because Dave hasn't brought everything in there, the basic rule is sort of like this. If it's a sale and leaseback and it results in an operating lease, generally the gain or loss is a real gain or loss, with one exception. If the sale is greater than fair value, there is no way you could potentially think of a justification for the sale price to be bigger than fair value in an arm's length transaction. Why would anybody pay more than fair value for an asset? There's got to be something dodgy going on. Now, if it's being used as part of a sale and leaseback, maybe the dodgy thing is they give us more up front, but we then make more payments later. So they're giving us a bigger loan or something like that. It's got to have something to do with the lease. So because you cannot potentially say, well, you can't possibly say that there's any sensible reason for the sale price to be greater than the fair value, that excess must not be a normal profit. It must somehow relate to the lease. So if the sale price is bigger than the fair value, we do exactly the same thing that we did with the finance lease. We shove it on the balance sheet and we dribble it out to the income statement over the life of the lease. Okay? In all other circumstances, the profit or loss is immediately recognised. Okay, so what have we done today? Oops, sorry, so I get overboard. What have we done? We've said, look, leases theoretically are just rental arrangements. But in practice, some leases are actually financing arrangements. So we need to identify which ones are financing arrangements, even though they're called leases, and which ones are rental arrangements. The ones that are rentals, we treat like a normal rental. The ones that are financing arrangements, we need to treat like a loan and an asset that's been acquired. Because remember, acquiring an asset doesn't necessarily mean legal ownership. It means control. If you've got control, then it's a financing arrangement. Okay, then we looked at a demo of that. We saw that accounting for a finance lease is the same as accounting for any other loan. Right? And that's the whole point. The whole point of this standard is to say all financing arrangements should be treated the same. It doesn't matter whether you call them a lease or a loan. If they're the same thing economically, they should be accounted for the same. Okay, then we did the demo, saw that, came back, talked about sale and leaseback. Why do you do a sale and leaseback? Well, it's a financing arrangement because it's a cheap way of getting finance. That's why you would do it. How do you account for it? Well, because it's really a financing arrangement, it's not really a sale. Any profit or loss on a sale and leaseback, if it results in a finance lease, is probably not a real gain or loss. So it needs to be treated in a special way.